Hi team. In this video we're going to talk a little bit about control equity transactions, where a buyer acquires a control equity stake. Because the overwhelming majority are structured on a cash-free, debt-free basis. So this is important in the event that you yourself would ever want to buy a business, which is totally feasible. In this video we will look at what it means to structure a transaction on a cash-free, debt-free basis, and then look at how this is presented and calculated in the context of a financial model. So let's define it first. What it means is that the seller is entitled to the cash on the balance sheet, and that the seller is also responsible for debts owed by the company, known as indebtedness. This language would most likely be first encountered in a letter of intent, or LOI, submitted to the seller by the buyer. And I'll provide an example of this document in a link below. Now, why would you want a company with zero cash on the balance sheet? Why is this really even acceptable? The logic behind a cash-free balance sheet is supported by the assumption that the company will have a normalized level of working capital on the closing date of the transaction, which would enable the buyer to continue to operate the business as it had been previously. Otherwise, inadequate working capital would create an immediate liquidity need. And as a conservative measure, and to avoid the associated risk, most acquirers will either secure a revolving line of credit with undrawn capacity prior to close, or raise additional funds to include a comfortable cash cushion. In a financial model, this cash cushion would appear as a use of cash under the sources and uses. Another argument for additional liquidity is that a new buyer is unlikely to run the company as efficiently as the seller had. Finally, a normalized level of working capital can be measured. How much cash to keep on the balance sheet is really at the discretion of the owner, and in any negotiation, eliminating opinion is helpful. The seller keeping cash, so long as the business can operate as it had previously, is fair. As it relates to the debt-free portion of this definition, while the seller is responsible for the amount of indebtedness, the debts are actually paid by the buyer. The seller will obtain and deliver to the buyer signed payoff letters prior to the closing, and the buyer will make payments to the appropriate parties with respect to the level of indebtedness of the company at close. This effectively reduces the base purchase price by the amount of indebtedness, without requiring the sellers to manage this process themselves. And since the buyer has a greater incentive to be certain that these obligations are met, this process provides a greater level of comfort for the buyer. Next, let's look at how this is presented in a financial model. In an LBO model, the cash-free, debt-free adjustments described would take place under the balance sheet adjustments. In this model, cash is eliminated under pre-close adjustments. To reflect a cash-free transaction, the sum of cash visible on the balance sheet, titled Standalone, would be eliminated with the following journal entry, denoted by the letter A in the image. Debit retained earnings by $1,250,000, and then credit cash by the same amount. As a simple example, indebtedness would then be paid off in step 2 under transaction. The journal entry to record paying down debt would be to debit the debt balance and credit cash. But reflecting a control transaction in just 2 columns requires several simultaneous transactions. In this case, the funds raised to close the transaction would be used to make these payments. Please see the description for a link on how all of this works at the same time. I'll include it below. But in this example, we're only including oldco senior debt. But the definition of indebtedness can go far beyond interest-bearing debt. And just interest-bearing debt can also include term debt, lines of credit, mortgages, lease obligations, and shareholder notes, and it can be expanded to include items such as extended accounts payable. For this reason, the definition of indebtedness in a stock purchase agreement is always very heavily scrutinized. And here's why. A broader definition of indebtedness gives the buyer more protection and leaves the seller with less proceeds, while a narrower definition of indebtedness increases the sum of proceeds received by the seller. So basically, if you're buying a company, you want to know that these obligations aren't coming with it. And if you're selling the company, you want to maximize dollars received. So it's absolutely critical to understand. All right, guys, that's it for now.